Hey everyone, welcome to another video on the channel. Today we're going to be looking at Zim Integrated Shipping Services Limited, also known by the ticker symbol ZIM. So Zim just reported their quarterly earnings this past week, and man, it was not particularly pretty. We're going to get into all of that and everything else that's going on with the company currently. But before we do, let's just take a look at the chart over here. So you can see this is the 1 month. Let's go to the 6 month. So not a very good looking chart. We could see it's basically just in a downward cycle. If we go to year to date, let's do 1 year. Yeah, we're just making lower lows, lower highs, lower lows, lower highs. Although we were at this point earlier around between $11.50 and $12, and we were able to hold and bounce. So we'll see if we could hold around this level around $12 and see if that will give us some support in the future, because the stock right now, I mean, the news is not particularly good, although the company is trying to mitigate some of their losses, and they do have a pile of cash that will hopefully help them through this harder time. But let's get right into the earnings. So, no dividend this quarter because they were crushed. Although they did reiterate their plan to provide dividends of 30 to 50% of their operating revenue in the future, which is what they have been doing in the past. So getting straight to the numbers, so in Q2, they had a net loss of $213 million, or $1.79 per share, a net income of $1.33 billion, or $11.07 a share in the year earlier, which is quite a dramatic shift. So they went from $1.33 billion income gain to a $213 million loss year over year. That's a big, over $1 billion swing over there. That's huge. But again, it's what we've seen for this entire year with shipping rates and their exposure to the spot market. So not a giant surprise, although they had earlier in the year said that they expected rates to recover in the second half of 2023, and now they've basically given up and said they're not anticipating rates to recover until 2024. So we'll see what happens, how the rest of the year plays out. But in the meantime, Q2 adjusted EBITDA and adjusted EBIT margins were 21% and minus 11% compared to 61% and 51% from a year ago. Not great. This is really the crux. This is why we're having this discussion. Q2 average freight rate plunged by 2/3. That is a big plunge indeed, from 1,193 TEU from 3,596 TEU a year ago, and it's still down from. In Q1, it was 1,390. Now it's only 1,193. So that's the crux of everything. That's why they're suffering these losses, because those rates have just plummeted by 2/3. Even though, this is interesting, carried volume rose. So they're actually carrying more goods. I mean, not a lot, by 0.5%, but still they're carrying more. TEU is increasing, but they're still losing money because the amount they're getting for carrying that is just going down. Not ideal. Their total cash position fell to $3.2 billion from $4.6 billion at year end. So that is quite a drop. That's $1.4 billion just this year that their cash has diminished just over the course of 2023. So we kind of saw this coming. They did adjust their guidance in July. That's basically when they gave up and said that they're not anticipating rates to recover for the rest of 23. And so the company is just bleeding money, and they're in a position now where they really need to start seeing these rates start to rebound. And will they rebound? I mean, it's an open question. We'll get into that in a little bit. But and here they said on the call, their guidance reflects continued weakness in freight rates all across the company's trades, particularly in the Trans-Pacific, which the company expects to continue during the rest of 2023. And volume growth is expected to be lower as well than originally forecasted because demand is continuing to decline. Now, what is Zim doing about this situation? Because they're not taking this passively, which is good. One thing they're doing is they're downsizing their fleet, which, I mean, it makes sense because the demand is so low. So, they emphasize this on the call. To anyone that hasn't listened, I'd encourage it because they're focusing now more on cost cutting until rates are in a place that they could expand again. And so we see that they've been terminating several charters for Euroseas over here. They're just cutting market exposure in general. And they're now making a bigger effort to actively manage their fleet. That's the thing. So Zim charters out something like 90% of their vessels, which is high. Most companies are more closer to 50% that they charter out. So they're letting a lot of these contracts terminate early or just terminate on schedule and just taking some of that extra capacity out of the way so that they could diminish their costs, which, okay, is that going to be enough to bring them to profitability? Probably not yet, but there are some other things that they're working on, namely, they're increasing their exposure to the spot market, which I don't know if this will come back to bite them. It makes sense right now, as we'll see. So 70% of their Trans-Pacific capacity is on spot, only 30% on contract, which it's huge exposure to the spot market as opposed to long-term contracts. Now, why is that? I mean, keep in mind, this was an interesting thing that the article brought up. Freight rates are still up 20% versus pre-COVID levels. So that also tells us if freight rates diminish to what they were pre-COVID, Zim still has a little bit of ways it could go down. We're not even down to where we were pre-COVID. So are we going to go to where we were pre-COVID? Are we going to go even lower than we were pre-COVID? That could be bad news for Zim. But it's also worth noting, this is another interesting point, the spot rates right now are actually higher than they were. Not since pre-COVID, but over the past quarter. So over here it says since the container index, spot index, is up 27% since the beginning of the third quarter to 3,363 per FEU as of the week ending August 10th. The Baltic Daily Index, FBX, China East Coast assessment is up 20% since the beginning of July. So the spot rates have been going up in the short term, which it makes sense now that they're kind of readjusting and putting a lot of their ships on their contracts based on the spot rates now to take advantage of this. I mean, the problem then, of course, is that let's say the spot rates diminish, they have this capacity and they don't have contracts locking them in. So it's a bit of a risky play, but again, their options are limited now because they are, as we saw in the last article, they're diminishing their capacity. They're relying more on spot rates to try to take advantage of this at least temporary increase in the spot rates, and we'll see if that's enough to hold them over. Again, I'll refer back to that number we saw in the first article, which is their cash position is diminishing. They had over $4.5 billion at the beginning of the year in cash. Now they have like $3.2 billion. So it's really a race to see if the rates will stabilize or even increase before that cash number goes down. Because they are, as we're saying, like I don't anticipate the cash to diminish as quickly as it has been, because they're not going to be paying dividends for until the situation improves, and also they're taking away some of this capacity that they have, and they're focusing more on cutting costs. So the race is on. We'll see what happens, but none of this is financial advice. Make your own. This is only for educational and entertainment purposes. So by all means, do your own research and let me know what you think in the comments. Do you think that this is maybe a buying opportunity, that Zim, their PE ratio is like less than 0.5 at this point? Maybe this is a good chance to jump in, and maybe the rates will stabilize in the future. I mean, I think a lot of what's happened so far is that people for this whole past year have been pricing in a recession that just hasn't really materialized. So everyone was pricing in this recession, saying that, oh, of course, there's going to be less economic activity, there's going to be problems with China, all this, reasonably so. But here we are today, still kind of waiting, and all that has been priced in already. So maybe that's a buying opportunity. Maybe you think there's a lot more to fall. As we said, there could be, if the spot rates are still 20% higher than they were pre-COVID, maybe there's a ways that they still have to go down, and they'll go even lower if there is a recession. So are you buying? Are you selling? Are you just holding on to the shares that you have? Let me know what you think in the comments section, and I'll catch you in the next one.